Assalamu alaikum. Welcome to lecture 15 of financial reporting. This is IFRS 16 leases. So in this lecture, we are going to go through lease versus buy. Scope of IFRS 16. Then the lease contract. Definition of a lease. Identifying whether the contract contains a lease or not a lease. The lease term. And then comes the lessee accounting. Overview of the lessee accounting, recognition exemption, lessee accounting model, measurement of lease liability, and measurement of right of use assets. So in this lecture, we are only going to focus from the lessee's point of view, not the lessor. Earlier, under IFRS 16, what we used to do, we used to account for both lessor and lessee. Now we are only seeing from the lessee's point of view. Okay. Now, sale and leaseback. So, sale and leaseback transactions. If your transfer is a sale, how do we account for it? And if your transfer is not a sale, how do we account for it? Then comes the presentation and disclosure like any other standard. This is the last part once a recognition and measurement has been done. That is, how do you present the leases and how do you disclose the leases in a financial statement? And finally, we are going to see which part of the syllabus we have covered from this lecture, summarize the entire lecture, and whether there are any technical articles available for leases or not. So this is the overview of the lecture. Under IFRS 16, first we'll go through and see whether the contract contains a lease or not. Then, if it's a lease, we are going to follow the lessee accounting. And if we are going to do a sale and lease back, we have to see if the transfer is sale or not a sale. And finally, presentation and disclosure. So let us start with lease versus buy. A company can acquire assets in two ways. Either they can buy it outright, where they pay the amount and get it, and they're actually owning the asset, or they can enter into a lease arrangement. Main advantage why company is going to lease, because it helps you to spread your payments over a number of years. You don't have to make a one time payment, and therefore you can avoid any upfront cash payment, and it is also a cheaper source of fund also, rather than taking a loan to purchase your uh, payment, to finance your payment to buy an asset. Okay, even though a lease asset you might never own it outright, but a lease arrangement may allow for any upgradation or replacement of your asset without the expense of buying newer models. Okay, although assets can be leased. Okay, so these are the any assets can be leased, but these are some common examples which are leased: computers, vehicles, printers, property. Okay, now IFRS 16 applies to all the leases except those that falls within the scope of another standard. For example, biological asset. Leases of biological asset will be covered according to IS 41, not IFRS 16. And IS 41 I have covered in my previous lectures. You can watch in my FR playlist. Now, definition of a lease. What is a lease? A lease is a contract for the right to use an asset for a period of time. What is an underlying asset? An asset that is subject of your lease. Okay, in lease contract, one party known as lessor, and the other party known as lessee. So lessor is the one who is going to give that asset to a lessee to use it, and in return lessee is going to pay lessor for using that asset for a fixed period of time. Okay, now determining whether a contract contains a lease. This is very important, and this is what you have to identify in your exam. You might be given a contract, you have to see whether there's a lease or it's a performance obligation. If that contract is not a lease, then you have to deal according to IFRS 15 if you are satisfying performance obligation. But if it's a lease, you will deal IFRS 16. Okay. So an entity that enters into a contract with another party to obtain the right to use an asset, they must assess whether the contract contains a lease or not. If it contains a lease, okay, how do you know? Two things will be there. The contract will convey the right to control the use of an asset, use of an identified asset, for a period of time in exchange for consideration. That means you will be able to use an asset, an identified asset, and you will be able to control the use of it. These two things has to be there in that contract for it to be a lease. So each identified element has to be present in order for a contract to be lease. The two terms will be discussed below. One is the control the use and the other one is identified asset. Very important. This has to be there for your contract to be a lease. First, let's go through control the use. Okay. So the right to control an asset exists if the entity that obtains the use of that asset has the right to do these things. First, they has the right to obtain all the benefits from the use of the asset. This means no other party will have access to that asset while they're using that asset. Okay. Only the entity who has obtained that asset can use it exclusively for the period of the contract. Next, entity can use it itself or they can sublet it to another party and from which they are going to earn rental income. Remember, they can have a use, they can have a say, but and direct the use of the asset. What does it mean? Entity that obtains the asset can direct how it will be used and what it will be used for. They will have a say. Okay. Next, so this is an example where there's a control to use. We'll see whether they are having the control, they are controlling the use or not in this contract. So let us go through this example. It's about AB entering into a contract with a road haulier RH to transport its goods from London to Edinburgh on a specified truck. So the goods will occupy all of the RH's truck. The contract specifies the good to be transported on the truck, pickup, and the delivery dates. RH will operate and maintain the truck and they are responsible for the safe delivery of goods. AB is prohibited from hiring another haulier to transport the goods or operating the truck itself. So because AB is prohibited, what is the conclusion? AB does not control the use of the truck. They are not having a say on how they have to use the truck. RH is deciding it for them. So this is not a lease for them. So in this case, ABC, they have the right to get all the economic benefits by using the truck over the contract period. How? Because good is occupying all the truck's capacity. That means it is preventing other parties from getting the benefit. But one condition has been met. But the second condition, they are controlling the use but directing the use. They are not having the right to direct the use. Okay, ABC is not directing the use. Why? And ABC can't change it also. Because ABC will have the same right regarding the use of the truck as if one of the many customers transporting goods using the truck. Who is deciding it for them? AB is deciding. That's why they can't hire another haulier to transport the goods because they can't direct the use. So that's why it's not a lease for AB. Now, identified asset was the second part. In order to be a lease, a specified asset has to be identified in the contract. For example, and this may be a proportion of a single asset if it is physically distinct. For example, one floor in a 20-story property. It's an identified asset. Okay. An asset is not identified and a contract is not a lease if the supplier has the right to substitute it for an alternative at any time in the contract, except in the case of substitution when a repair is necessary. What does it mean? That means you can't have a substitute for it. Okay. If you are having a substitute, that contract is not a lease. Okay. But you can only substitute when a repair is necessary. Other than that, any other substitute is not a lease. Now, example 2, identified asset. So in this case, it's about trucks. So trucks Russ contracts with a local government authority, that is LGA, to provide 20 trucks for using in refuse collection for 6 years. The registration number of these 20 trucks are specified in the contract. Okay, and if the truck needs to be serviced or repaired, the truck's Russ is required to provide a substitution of the same type. Otherwise, they cannot retrieve the truck during the 6 years unless LGA fails to make a lease payment. What is this? This contract is a lease. Why? Trucks have been identified. They are specified in the contract, and once it is delivered to LGA, trucks can be substituted only when they need to be serviced or repaired because you can't find a substitute. That's why it is a lease. Now the lease term, very important. Lease contract includes a lease term also. That is the period of time that the lessee can use the asset in a lease contract. What is the lease term? Non-cancelable period for which the lessee has the right to use an asset, together with both periods covered by an option to extend, periods covered by an option to terminate the lease. So in that lease term, this is included. First one, period covered by an option to extend the lease if the lessee is reasonably certain to exercise that option, and periods covered by an option to terminate the lease if the lessee is reasonably certain not to exercise that option. That means they might terminate the lease. So if you have the terminate the lease, your lease term will be shorter. If you have the extend, you will take with the extend period. That would be your lease term. Okay, non-cancelable means you can't cancel this period. That is known as a lease term, during which lessee can use the asset. Now, example 3, we'll see the lease term for the two contracts. So the first contract, that a lease. So Global is entering into two lease contract. First, let's see the first one. First one is a lease to obtain the use of machine. The non-cancelable lease term is 3 years. That means lease term is 3 years and they have an option to extend for further 2 years. So you have to say whether lease term is 3 years or it would be 5 years. So in this case, management is certain that Global will extend the term. Because they will extend the term, with 3 you have to take the 2 years also extension. So your lease to option the machine would be 5 years. Okay, that extension is included because management is certain they will exercise the option. Second one, lease to obtain the use of a factory. Lease term is 20 years. Global can cancel the lease without penalty after 15 years, and they expected that they will do so. That means they expected to cancel it after 15 years. So your lease will not go up to 20 years. Your lease for the factory will be for 15 years. Okay, this period is covering the termination option. Because management is expected to terminate early. Now, lessee accounting. So IFRS 16 requires a lessee, the one who is taking the lease, to require all the leases in the statement of financial position unless recognition exemption applies, which we'll see in the next slide. What recognition exemption means. When a recognition exemption applies, we follow simple accounting, okay, to the lease. When a lease is recognized, it will be recognized in the statement of financial position. Okay, two things will be recognized: liability and an asset. A lease liability and a right of use asset. Why? Lease liability because you have to make payments, of course, for using it to the lessor. That is your lease liability. And right of use asset because you are using an asset. Even if you are not owning it, like your non-current asset or intangible assets or investment property, but still you are using it. So in your statement of financial position, until you are using that asset under lease, you have to recognize it as right of use asset. You have to write this name. You just can't write asset. There are so many types of asset. Right of use asset and lease liability. What is the meaning of right of use asset? An asset that represents the lessee's right to use an asset for the lease term. Now, simplified accounting. What is the meaning of recognition exemption? See, simplified accounting can be applied for two types of lease. First type, short lease. If your lease is for 12 months or less than that, and it do not include a purchase option. That means you can't purchase. You can't own the asset at the end of the lease term. Okay. Next, to those lease for which the asset when new is low value. See, when new, not old. First time when you are buying it, the asset is of low value. IFRS 16 did not define what low value asset means, but they are suggesting that assets like personal computer, tablets, small items of furniture, mobile phone, when you are leasing this, they are low value lease, so you will follow simplified accounting for them. Okay. Simplified accounting means an entity must make an election to apply this recognition exemption. That means they have to make an election to apply simplified accounting. This is not automatic. This is made when by class of underlying assets for short-term leases or on a lease by lease basis for low value asset. So when you have to see whether your asset is short-term lease or not, you have to see by the class of asset. And when you have to see for a low value asset, you have to see lease by lease basis and make the election. Now, accounting treatment. When a lessee elects to apply the recognition exemption means it is exempted from recognition. So your lease payment, you will not recognize an asset also, you will not recognize a liability also. That means no lease liability, no right of use asset. Then what do you recognize? Your lease payment will be recognized as an expense in your profit and loss on a straight line basis. Same like depreciation expense over the lease term. So no asset, no liability recognized other than your lease prepayment or accrual. Now, example 4, short-term lease. So let's see this. So, On 1st April, Case entered into a contract to lease an office for 1,000 a month that is payable in advance. Under the contract, the non-cancelable term is 12 months. That means the lease term is 12 months and first 2 months are rent-free. See, it doesn't matter whether it's a rent-free or not, your lease term is 12 months. Now, under the simplified accounting, your lease expense would be 10 because out of the 12, 2 months are rent-free. So 10 months into 1,000 will be recognized on a straight line basis. Okay, and it will be prorated regardless of the rent-free amount. We want to know per month how much it is. So 10,000, okay, this lease expense will divide by 12. So it's 833 a month. Okay, so during the financial year ended 31st December 2001. See, we are starting on 1st April 2001. So from 1st April 2001 to 31st December 2001, it is a total of a 9-month duration. That's why we have found it per month. You see, that's why we have done this prorated, because it is not for a 12-month period. Lease term is 12 months, but your financial statement is for 9 months. So in order to get the 12-month figure into 9 months figure, you first have to find out the total rent. That is, you are paying rents only for 10 months out of this 1,000, which is 10,000. You have to divide it by 12, which is 833 a month. Okay, so that 833 you will multiply by 9 to get the total expense for 9 months. That is 7,500. But how much are you actually paying? You are only making 7 monthly payments. That is 1,000 a month. So 1,000 into 7, that is 7,000, which will start from 1st June. Okay, so therefore at 31st December there is an accrued expense. The amount of expense is 7,500. You are paying 7 monthly installments, that is 7 into 1,000, 7,000. So the difference 500. So you will recognize this expense 500 in your statement of profit and loss. This is under simplified accounting. So you will only recognize prepayment on an accrued expense. You will not recognize an asset or a liability like this case. Okay, so we have to find the cash and payment with the accrued expense. The difference is your accrued expense. Okay, now lease accounting model. At the commencement, when the lease starts, lessee has to recognize two things: lease liability, right of use asset. And IFRS 16 is giving guidance on initial as well as subsequent measurement on both of this. So let's start with the lease liability first. Initial measurement. Your lease liability is initially measured at the present value of the future lease payment. See, lease payment you are going to get in the future, but today you have to find out the value. You want to know the lease liability today, so you have to find the present value of a future lease payment. And that means you need a discount factor. So your lease payments are discounted using the interest rate implicit in the lease. And this interest rate implicit in the lease, you never have to work it out. Thank God, it's always given in the question. Okay. But if the interest rate implicit is not given, you can use the lessee's incremental borrowing rate as a discount factor to discount your future lease payment. But either they will give you the interest rate implicit or the incremental borrowing rate. You don't have to work out on this. Straight away is given, just straight away use and discount the cash flows. Now, interest rate implicit in the lease. This is the rate of interest that causes the present value of the lease payment and any unguaranteed residual value to equal the sum of the fair value of the asset and any initial direct cost of the lessor. Okay, the internal rate of return of the lessor's cash flow. Okay, you don't have to know the definition and all, just know we use it to discount our future lease payment. Now, future lease payment in the present value calculation includes this. First one, fixed payment less any lease incentive. If there is any lease incentive, you will deduct it from the base payment. Fixed payment. What is lease incentive? It is given in the bracket. Payments that are made by the lessor to the lessee. Of course, see, if a lessee is making a payment, that will be net off against the any payment made by the lessor to the lessee, known as lease incentives. Okay, so payment made by the lessor to the lessee or reimbursement by a lessor of cost of lessee that is receivable in the future. We do not want to know why the lessor might do the payment or how we have to calculate. If ever lessor makes a payment to lessee, it will be given to you in the question. You just have to take it and deduct it from fixed payment. That's it. You don't have to know how the lease payments are done, how the payment made to the lessor are done, and why they do it. Conditions, no. Next is variable payment. Variable payment are fixed in substance or they are based on a specified index. For example, consumer price index or central bank base rate. Next, exercise price of any option, purchase option if the lessee is reasonably certain to exercise it. If they will exercise the option, then only you have to take the exercise price. Otherwise, you do not take the exercise price if they are not likely to exercise the option. That is the option of buying the asset at the end of the lease term. Next, penalties that are expected to be paid for early termination of the contract. Okay, and if the lease term reflects that early termination. So if there are any penalties, that also will come in that present value calculation. So these four things you have to remember will be included in the present value. Now, subsequent measurement, that is about initial. After the initial recognition, liability will be increased by any, see, liability like any other liability will have an interest on that. For example, when you're taking a loan, it's a liability for us. We have to pay an interest on that. Same for this also. So your liability will be increased by any interest that is on that outstanding liability. And any payment that you make, lease payment that you make yearly, it will be reduced by the lease payment. So add the interest, deduct the lease payment from liability, in short. And the interest rate that you have to use to find the interest on the liability is the same that you have used as a discount rate to discount your future cash flow. Okay, the same discount rate that you have used initially to measure your liability. Now, so increasing this liability by the interest is also known as unwinding the discount. This term you will often hear in your provision also. That is my next lecture and next standard also, by the way, IS 37 provision. There you have to work out on this a lot, unwinding the discount. So first you use that discount factor to find the discount rate. Next, same discount you use to find the interest of that liability, known as unwinding the discount. The interest expense will be recognized in the financing category in your statement of profit and loss. It's a financing category because lease we normally do not take for operating purpose. Lease we take to finance. Okay, so it goes in the financing category. Always remember, since now IFRS 18 has been introduced, now you have to remember under which category your income and expense will be recognized in all your standards. Okay. Next, so let's see example 5, initial measurement, and then we'll see the examples for subsequent measurements also. This will make it pretty easy for you. So here you have been given about Hick who is entering into a lease agreement for 6 years. It's about a machine and they have deposited 2000 when they have signed the lease, and also further 5 payment of 2000 at the end of each year. They have an option to buy the asset at the end of 6 years for 500, which they are reasonably to exercise, and the rate of interest is 10%. So use the discount factor 10%, and the cash flows for the first 5 years will be 2000 and last will be 500 because that is the option to exercise, which you will use discount and find the present value. Remember, the initial payment of 2000, that deposit is not included in the cash flow because you have paid it before the lease started. Therefore, it is not a future lease payment. Remember, any payment done before you start the lease, it's not taken in your future lease payment. This you have to remember about initial payment recognition. Now coming to subsequent measurement, example 6. Okay. Here, this is following from your example 5. Same example. So let us go here to example 5 previously and check that your lease liability here, you stopped here. With this you will start in your subsequent measurement. Always start with this in your subsequent measurement. 7860. So 7860, you see, you will start here. This is your liability brought forward, and now you are unwinding the discount. You're finding the interest. How? 10% on this, which is 786, and now this 2000 you have to deduct the lease payment every 5 years, and you keep on doing it, and this balance 6646 in the first year becomes the opening balance in the next year. This closing balance in the second year becomes the opening balance in the third year. It keeps going on like this, keeps accumulating, and every year you will find 10% and minus 2000. At the end you will deduct 500, and you will always see here in your subsequent measurement your balance has to be cancelled off. It has to be 0 because whatever lease you have taken at the end of the final year, there will be nothing to be paid. You have paid off everything. That's why it's always 0. So this is a sure way of checking whether your lease payment, your subsequent measurement is correct or not. If your initial measurement is correct, your subsequent measurement will be correct. So at the how will you check it? At the end, it has to be 0. And this 51, sometimes it might not be 0. You might get some small difference, 2 or 3. That is because it's due to rounding difference. But still you have to take it as 0. Okay, that rounding difference is ignored. You'll be given full marks. Okay. So what you need to understand from this table, in your exam, in your FR exam, you will not be asked this for 5-6 years full schedule of lease payment or liability. That they will not ask, but at least they will ask for 2 years. Why? So that you can divide between your current and non-current liability. That's why. At least 2 years they will ask. So at the end of year 1, your lease liability is this 6646. Okay. And out of this 6646, of which 5311, that is for the next year, is non-current. See, your liability for the next year, year 2, in year 1, it would be a non-current. Okay, so of the 6646, 5311 is your non-current. That is the amount outstanding at the end of year 2. And the balance, if you find the difference between those two, is 1335 is your current. And there is another way of finding this out, the current balance, that is take your lease payment due in year 2. What is your lease payment due in year 2? 2000. And from that 2000 deduct 665, that is your interest, the year 2 interest. That has not yet acquired, and so it is not a liability at the end of year 1. You will get 1335. But if that's tougher for you, do the other way around. First find this, just find the difference between these two. You will get your current. This is non-current, so the balance is difference between them is your current liability. Now coming to example 7, but before going to example 7, let us read one note regarding example 6. That is, example 6 shows you a subsequent measurement of the lease liability where lease payments are in arrears. That means at the end of each year. You see that 2000 was deducted at the end of each year for a subsequent measurement. But if lease payments are in advance, that means at the start of each year, then your interest will acquire on the opening balance less a liability payment, less a lease payment, sorry. So from your liability, deduct the lease payment and then find the interest. Now the format will change as illustrated in example 7. And in your FR exam, as I told you before, you will not be required to calculate the lease liability throughout the whole lease term. But you have to prepare calculations for one additional year beyond your current reporting period so that you can split the liability between current and non-current. Now, example 7. So let us change the situation. Now your initial liability is measured at 12,412. Lease payments are made 2000 in advance for 8 years and rate is 8%. So you will use the interest rate at 8%. Now, so from your liability, first deduct lease payment and then find the interest. Okay. So this is the amount carried forward. You will be getting the interest at 8%. Then, and this closing becomes opening. Deduct 2000, find 8% on that. Keep on doing like this. And here also at the end, you have to get 0 because it's a subsequent measurement. Okay, this is payment in advance. That was example 6 was payment in arrears. That is the only difference. The rest everything is same. So here at the end of year 1, your lease liability is 11,245. This one. Okay. So this, out of this, 9245 is your non-current. That is this amount that you have carried forward. The amount outstanding after the year 2 lease, and 2000 is current because you are paying currently 2000. See, now you are making advance payment. So this is your current. So just deduct 11,245 by 1000, you will get 9245. Okay. Now, that's about lease liability. First, we always measure lease liability only. We need that. Then only we measure right of use asset. Okay. Right of use asset is like any other asset. It's your asset, which will be recorded in your statement of financial position under assets. So now measurement of this. Here also initial measurement, subsequent measurement. Initial measurement will be measured at cost. Like any other asset, like under IS 16, how we measure PPE under cost. This is also at cost, which includes initial measurement of lease liability. Now you see why we recognize liability first, because we start with the initial measurement of lease liability. Of course, whatever you pay as a liability will be your right of use asset. Plus, there are some things that you have to add under right of use asset, but not for lease liability. They are Payments made before lease commenced. Deposit. Remember, deposit we ignored in the lease liability, but for right of use asset, you have to add it with the lease liability. Plus direct costs that are incurred by the lessee, like installation cost. Plus any estimated cost to dismantle or remove the asset at the end of its economic life for which a provision is made according to IS 37. Okay, this also you have to add. So you have to keep on adding all this with the initial measurement of lease liability. Initial measurement of lease liability you have to calculate, and then with all this you will add this. So the cost is reduced by any lease incentive received from the lessor by the lessee. So if you have received from the lessor before the commencement of the lease, before the lease starts, if you have received anything from the lessor, your cost will be reduced by that lease incentive. Now remember, when you are measuring, okay, the asset that is obtained by the lessee may be used by the lessee, or it may be sublet as an investment property, possible. So the situation differs. If you are using it, accounting is different. If you are subletting as an investment property, measurement is different. First, let us finish out the investment property part. If you are subletting it as an investment property, then the lessee will apply IS 40 fair value to investment property. Remember, you cannot go by cost model. That option is not there. Whenever they specifically tell you fair value model or cost model, that means you have to go that. If they are giving you a choice, they will tell you this or that, fair value or cost model. Since they have strictly told you as fair value, there is no option of going by cost model for investment property that is held as a right of use asset. This is for IFRS 16 point of view I'm talking about. But under IS 40, if it's an investment property, yes, you have a choice, cost model, fair value model. But here we are going to use fair value model to investment property. Then you have to measure your right of use asset at fair value and any gain and loss. Fair value, of course, if it's fair value, you will be having gain or loss at the end of the reporting period, because at the end of each year, your fair value might either go up or down. That's a gain or loss. So that fair value gain or loss will be recognized in the investing category, because it's an investment property. Investing category in your statement of profit or loss. Anything to do with investment property will go in the investing category. It doesn't come in the operating category. If your right of use asset is measured at fair value, remember, it is the fair value of the right to use that asset that is relevant, not the fair value of that underlying asset. You understand? Now, if the underlying asset is used by the lessee, notice it is not given as an investment property. You are using it, the lessee is using it, then it will be measured using the cost model. In some circumstances, revaluation model. So here they are giving you a choice under IS 16, cost model, revaluation model. If the asset belongs to a class of assets that has been revalued, lessee has to choose to apply the revaluation model to all the right of use asset in that class. If there is no reasonable certainty that the lessee will obtain the ownership at the end of the lease term, asset will be depreciated over the shorter of your lease term and useful life. Remember, this is only when lessee is not going to take the ownership at the end of the lease term. Then only shorter of lease term or useful life you will depreciate your asset. But if the lessee will take over, they are going to retain that ownership at the end of the lease term, asset will be depreciated over its useful life. Depreciation expense will be recognized in the operating category in your statement of profit and loss. Now example 8, where we are measuring the right of use asset. So earlier we have measured the lease liability. Now right of use asset. So here you have been given a machine that you have leased for 6 years, depositing 2000, further 5 payments of 2000 at the end of each year. Liability they have given you, measured liability is 7 and 60, installation cost 600. They are going to exercise the option to buy, and machine has a useful life of 8 years. So your lease is 6 years, machine is 8 years. Because you are buying it at the end, you will depreciate over 8 years. Okay. So what are the things you have to add in your right of use asset? In your initial measurement, the initial liability 7 and 60, deposit and installation cost. Then this 10 for 460 you are going to depreciate over 8 years, over useful life, because you are going to take over the asset at the end of the life. So this is the depreciation. Now, activity 1, lease payment in arrears. So let us do this question. This is about Delta entering into a contract started on 1st Jan 2008. They have that is the day they have started the lease. They are requiring 6 annual payments of 2000, first payment on 31st December. They are incurring a further 1000 in installation cost. Delta will return the asset to the lessor at the end of year 6. And initial measurement of the lease liability 8710 using the interest rate 10%. You have to show how the lease, show the measurement of the lease over the 6-year term of the lease, calculate the amount to be presented in the statement of financial position. You have to know both, by the way. One, measurement of lease. Second, how it will be presented in the statement of financial position. Let us do this. So now I'm going to recognize the year, then amount owed at the start of the year. So I'll just write start, and interest at 10%, then the rent, and end of the year, end. Okay, so now there are 6 years. So the amount that has been given is 8710. Okay, just add one figure and just apply 10%, 0.1 into this, done. And then minus 2000. So this 2000 remains 2000 for all the 6 years. So I'm just going to copy paste, and here just do the function, sum function. We do this, done. Automatically you get the amount, and then this amount would become here. So copy paste the value, or you can copy with the value. So let's take the value. So what I'm going to do is I'm going to take it like this. No, I have to apply the 10% here to this, and automatically I'm going to take this down. Automatically the functions will be performed. Okay, and then this I will copy here, take the value, 10% on this, and I will just drag it down. Automatically the functions will be done. 4973. And it is this amount here, value, 10% on this, here. So I'll just take the value here, copy the value, and then 10% of this amount, done. Now because I need to present them in the statement of financial position, I need the total of my interest. As you see here, see there is a small difference of -1, that is due to rounding difference. Okay, but it would be 0. So this is the amount of my interest. It could be one figure up or down. Your interest could be 3,290 or 3,290, 91. It doesn't matter as far as you are close to this answer. So part A has been done. We have measured the lease. Now in part B, the financial statement. How are you going to present this in your financial statement? So in the statement of financial position, you are going to show it as current, non-current liability. Current, non-current. Okay. So the amount is 7581. Out of this, the amount that is current, so you are currently paying 2000. So it's 2000 minus the interest that you have been paying for year 2, that is 758. And your non-current is the difference between this and this, 6339. This is your non-current. Okay. Now the right of use asset. So this classification of current, non-current, very important. Students often make mistakes here. Okay, because out of this 2000, the next year's interest which you have to pay, you will deduct it, and that is your current, and the balance. So when you deduct this with this is the amount, non-current. In short, another way of getting this is just look at this figure. This will be your non-current in your current financial statement. You see, and this is your amount at the end of the first year. So the difference between this two, 7581 and 6339, is this 1242. So you will automatically get the current. Now right of use asset. This is lease liability. Right of use asset. Okay, ROU. So this, first you have to find the cost. Then you have to find the depreciation. And then you are going to get the carrying amount. So what is the cost? So when you're taking the cost, you have to add the lease liability, that is this already given to you, plus the installation cost of 1000. Done. Then you are going to depreciate this by 8 years. Sorry, 6 years. 6 years. Okay. Drop down the zeros. Avoid decimal. And you have to deduct this from this. And your carrying amount is 8092. Now let us go to the next activity, activity 2. This was lease payment in arrears, and this is also lease payment in arrears. Wait, no. So this is a lease payment in advance. Okay, same scenario, we'll just change the figure here and there. So in A, you have to calculate the interest and depreciation expense for year 31st December 2008 and 9, and B, calculate the current and non-current lease liability in the statement of financial position. The twist here is, look at the date when you have entered into a contract. You have entered into a contract on 1st July 2008, and when are you supposed to show? For 31st December 2008, 6 months. That's for 6 months. Okay, and the lease payment for 5 annual payment is 30,000. You will incur a further 10,000 in installation cost, and Delta will return the asset to the lessor at the end of year 5. Initial lease liability is 91,119, and interest rate is 12%. So let us quickly do this. Okay. Now, part A. So here, interest and depreciation, statement of profit and loss. So statement of profit loss. I'm just writing the initials. Okay. Remember, depreciation will go in the operating category. Okay. And financing category, you will write the expense. So here, depreciation will go. And here, financing category will write the interest expense. This is for 2 years. One is 31st December 2008 and the other one is 31st December 2009. So I will just simply copy paste this. Done. And just change the year. Okay. And part B is the lease liability. Non-current and current. So lease liability. Current. But remember, we need a working for this. Okay. So in the same table, I'm going to show the working that I've done my activity 1. I will just change the figure here. Since I already have, and it is not for the 6 years, it's for 5 years. So I will just take this out. Okay. And it is 1st July brought forward. So what is the amount? 91,119. And interest would be at 12%, but for 6 months you have to take at the end of from July to December. But first let's take for 6 months. Okay. So when you're taking it, it's 12% into 6 months. 5467. So you do not need for the whole year. You only need for the current year and the next year, so that you can write the current and the non-current amount. Okay. But of course, for depreciation and interest expense, you would need. Now, so this interest 5467, okay, you will write in the current year. Here, in the financing category interest for December 2008, because that is from July to December, for 6 months you are taking. So this interest you will write 5467. You have already worked it out. And for December 2009, you need the interest. Okay. So to find that interest, you need the next year's interest as well. So let us do that. And what is the amount? 30,000 is the repayment. So wait, 30,000 starts from, say this is for remaining 4 years you need, okay? In the first year, you just have to find for the 6 months. You have to adjust, and then from there onwards, you can do yearly, because it is from July to December, and thereafter you can do for every December for 1 year. Okay. So for remaining 4 years. So here, when you are doing this, repayment of 30,000 will not come here. It will come here. So here, the amount would be this, 96,586, which we are going to use here. Okay, but there is a confusion here, because this is when you come here, you need the amount for 1 year. and this amount with the interest you have already deducted for 6 months. Okay, so this amount that you are getting here, let's write the date, 31st December. This is as 31st December. Okay, and this amount was brought in 1st July. So add another 6 months here to get for 30th June. So to do that, you just add the interest twice. Just double this interest. So here you will add this with this amount, since you have, see, this amount you have already added this to interest, right? The start and the interest 12%, and you have taken 6 months. Now when you do it, just take this to and add this interest again. It's twice because it's half. Then you will get for the year. Okay, don't get the bracket, just okay, just put plus. So this is the amount you will get for 30th June. So because this is for 30th June, in 1st July, when I go, I will bring forward this balance. I can't bring the December balance here, this balance. Sorry, I've made a mistake. It will be shown in this place, I'm sorry. It is with this, I will add this interest. So this balance I will brought forward here, 02053. So if this is done correctly, this will be automatically, it will be correct. Now I have to add a column here. So this 30,000 will be deducted from here. The repayment, it's in the start of the year, that's why, before you take the interest. Okay, so here it is the sum function, 72,053, the amount that has been brought forward. So on this you have to take 12% and take 6 months. Four three two three. So once you get this correctly, this is the amount I need. So this are the two interests, 5467 4323. So when you go here to 2009, you have to add both the interest here. It would be this and your new interest, that is 4323. You see, 9790. Exactly this interest. This interest. That's why I needed the second line correctly. So I've done my interest part. Now what do I need? Depreciation. So for depreciation, what do I need? The initial liability advance payment, installation cost. That's it. I do not need the rest of the lease liability table. So here, the right of use asset. Okay, the initial liability. What is the initial liability they have given? It is 91119. Then advance payment. Advance payment of 30,000 and installation cost. Installation cost of 10,000. So that's it. The initial amount recognized is the sum of these three. Liability, advance payment, installation. And now you have to depreciate this over 5 years. This divided by 5. This is my depreciation, 26224. Okay. So now I will go to my table here. For December 2008, I just have to take half of it because it is for 6 months, 26224. But when I take for 2009, I can take the whole figure, 26224. Depreciation which will come in the operating category. So here 26224. Here when I go, I'm going to take this but divide by 2, half of it, because for 6 months. You see? And so it's done. Now lease liability, current and non-current. So for non-current, I have to go to my table and see here. It is 96586. Okay. From this, what should I do? I have to deduct my current. Okay. See, it's your choice. You can either fund current or non-current in any order. Okay. There is no fixed order like this. So let's find the current first. So current is easy. What the payment you are making? Advance payment is 30,000. From this, you will deduct the next year's interest to find the current. That is, as already you have calculated here for 2009, this is the interest, 5467. So here, when you go to current, the payment that you are making this is 30,000, and since this is in the next year 2009, this interest, you have to deduct it. You will deduct the interest. So from 30,000, you will deduct the interest. I'm sorry, this is the current year's interest you will deduct. So this is your current. And non-current, how are you going to find out? Simply go here. This is the amount we have got, and from there deduct your current amount that you have just got. Okay. So from there, that is 96586 minus this. Done. So 7205, this is my non-current. So from the current year, 30,000 payment, just deduct the current year's interest. You get the current, and then you get the non-current. So this is the solution for activity 1. As you can see, we have done for the 6 years. We have started with the payment amount given at 10% interest and deducted the 2000 payment and got the closing balance. And then we have got this amount where we have divided it into current and non-current. So the difference between these two is the current, that is 1242, and the balance is non-current. And the right of use asset, we start with this payment at the installation and divided it by 6 to find the depreciation. Now, in activity 2, so this is the solution for activity 2, where we have divided our expenses in operating and financing category. In the operating category, we have depreciation for both the years, and in the financing category, we have the interest expense. And the depreciation that we have calculated in working 2, we just take for 6 months for 31st December 2008, because we start from July to December. But for 2009, there is no issue. We just take the depreciation that we have got in our working. And when we come to the interest, which we have done in working 1, we write the amount in the current year, and then in the next year we add the next year at the current year and get the interest expense for 2009. And for lease liability, we first find the current 24533, which we deduct from the amount given and get our non-current amount. And current is 30,000, that is the amount that we are paying minus the current year's interest. Now, so these are the workings that has been done. Of course, this full working is included for the completeness. It is not required for this question and it will not be asked for the financial reporting. Now, there is one twist in this question is that you see it is for 6 months. The first period is for 6 months. So you see in year one, it is only you don't have any 30,000 payment, and your brought forward balance is this, which is on 1st July. So from July to December, you have 2 year end. One is December and one you have to calculate the carrying forward balance for 30th June. So first we take the 12% interest for the 6 months on this, and there is no 30,000 to deduct in year one and get the amount. So you will be adding the interest twice, this interest, to get the amount for 30th June. Once you get the 31st December year end, add the interest once again and get the amount for 30th June. This amount will be brought forward. So you always get the amount for 30th June. That amount you will use as a brought forward, and with that you are going to deduct the 30,000 and add the interest. Okay. So it is this two interest that is relevant. This and this. And for right of use asset, take the initial liability given, add the advance payment installation cost added, and divide it by 5 years for depreciation. So point number 2, as the lease starts exactly halfway through the financial year, you have to split the interest expense into two reporting purposes. One from 1st July to 30th December, the other one from 1st Jan to 30th June. Now, the interest rate implicit in your lease will always be given in the exam, so no need to worry about it. Now, the last part of this lecture, that is sale and lease back. An entity can sell an asset in order to realize cash, and then they can lease it back for continuing the use. The accounting treatment, this accounting treatment, where you are selling an asset and using it under the lease, is known as sale and lease back. So for sale and lease back arrangement, it depends. The accounting treatment depends on whether the sale, whether it's a sale, the transaction is a sale or not. If your transfer is a sale, it will be dealt according to IFRS 15. If you are meeting the criteria for the satisfaction of performance obligation. I've covered IFRS 15, you can watch under my lecture 5. And if your transfer is not a sale, we'll account for that as well. First, let's go through if the transfer is a sale. Assume your transfer is a sale. Okay. If the transfer qualifies as a sale, the seller or the lessee, who is the seller here? The lessee is the selling here. They will recognize the cash that they have received because it's a sale. Of course, you will be receiving the cash for sale. You will de-recognize the asset that you have transferred because it's a sale. Then you will recognize a right of use asset for the part of the asset that is leased back. Of course, when you're leasing it back after you're selling it, you will recognize the right of use asset under lease, and you will recognize a lease liability, and you will recognize a gain or loss because you are selling on the proportion of the asset that has been transferred to the buyer, the lessor. This involves prorating your carrying amount of the de-recognized asset and the total gain or loss. See example 9 for this. Now, example 9. So this is about a company entering into sale and leaseback arrangement, selling an asset for 750,000, which is the asset's fair value. The carrying amount of the asset is 640. Agreed lease was 5 years. The term of the leaseback required them to pay 120,000 in advance for 5 years. Incremental borrowing rate is 3%. Initial liability is 546,000. So the previous carrying amount, now you have to allocate between the amount that you have transferred and the right of the use asset retained based on the right retained as a proportion of the fair value. So this is the solution for it. First, for you to find the gain, you have to proportion your carrying value with accordance with your fair value. See, your carrying amount is 640,000. You have to know how much is on the right of use asset and how much is the carrying amount for the asset that you have transferred. You have sold for 750,000. Okay. 750,000 you have sold and your carrying value was 640. So the difference is the gain. So your total gain is 110,000. Even this you have to apportion. Okay. See, you are holding some asset under the right of use asset under the lease and you are selling. So the amount that you are retained, you need to apportion your carrying amount. That's why we are multiplying 640,000 by 546. 546,000. Okay. So 546,000 is your lease liability. 546 over 750, the amount that you have sold. So if you want to get the right of use asset, okay, first always start with the right of use asset. This is easy. Just take your lease liability, divide by 750,000, divide by your selling price, that is the fair value of the asset that you have sold, into carrying amount. So this is the amount that is relating to right of use asset. Then from 640, that is your total carrying amount, you deduct this right of use asset. So this is the amount that you have transferred. Okay. Then let us come to the gain. Gain also is the same proportion, 546 divided by 750. If you understood this proportion well, you have understood everything. This you have to do for the carrying amount as well as the gain. So this is the gain. This gain is relating to the right of use asset. Therefore, you are not going to recognize it. You only have to recognize the gain that you have got relating to the asset that you have transferred. That is, total gain is 110 minus this gain that is relating to the right of use asset. It is this. So this is the amount gain relating to the asset that you have transferred. Therefore, you'll recognize this gain. So this is your journal entries. Remember, debit side should match with your credit side. So you are going to receive cash, how much? 750,000, because you're selling it for 750,000, which is the fair value of the asset. Then you are going to recognize right of use asset, which is this. This is the amount. You see, the first working will give you the right of use asset. That's why you have to know. When it's a sale and a lease back, you have to do this proportion to find your right of use asset. Otherwise, you can't do it. Then you will credit three things: lease liability, gain. If it's a gain, you will credit, and if it's a loss, it's debit. And your property, plant and equipment, because you are selling it. So you are selling your property, plant and equipment 640,000. The whole 640,000 is credited. What is your gain? Gain relating to the asset that is transferred, not the total gain. 29,920 you will credit. And your lease liability, they have already given 546,000. This is given in the question. This they will give you. The only thing that you have to work out is the right of use asset, number one. Number two, the gain. Only these two things. Other things are given. So this gain you will recognize in the operating category. If your asset is property, plant and equipment that you are selling. But if your asset is an investment property that you are selling, your gain will come in the investing category. Okay. That's why it's very important, not just that you are selling, what item you are selling, what asset you are selling. Is it a property, plant and equipment, or is it an investing asset that you are selling? Accordingly, you will put in the correct category, the gain. Now, when the transfer is not a sale, it's easy. You will account it as a finance transaction. So the seller or the lessee, they will continue to recognize the asset in their statement of financial position as if there is no sale, because there is no sale. You will recognize the transaction proceed as a financial liability in accordance with IFRS 9. I will tell you why. This could be confusing. The second point could be confusing for students. See, this is similar to a loan secured over an underlying asset with the lease payment treated as a loan repayment. See, when it's a sale and a lease back and it's not a sale, okay, but you're leasing it back. So because you're taking it on a lease means you have to make a payment, okay, because it's not a sale. So when you're making a payment, you have to take it as a loan repayment that you're doing. It's like a loan you have taken, now you're doing a repayment. So what do? It's an obligation that you have to pay back, right? Like loan, it's an obligation that you have to pay back. Same for lease also, you have to make that repayment. Because it's a cash obligation, you have to pay the cash. Remember, any liability where cash is involved, it is financial liability. It's like a financial liability according to IFRS 9. So that's why you'll recognize a transaction proceed. Because it's not sale, the transaction proceed that you are receiving is your financial liability. Now, final part of this lecture is the presentation and the disclosure. How do you present leases? You present the following should be presented in your statement of financial opposition or disclosed in the notes. Right of use asset that are not your investment property separately from other assets. Right of use assets that are investment property will be included with your other owned investment property. Lease liability separate from all the other liabilities and separated into non-current and current amounts. So this is very important. Next, the statement of profit and loss. In the statement of profit and loss, you will write the depreciation for the right of use assets and the lease payment for your short-term and low-cost assets within your operating category. Your interest expense relating to lease liability, you will write in the financing category. So these are the two items. Next, in your statement of cash flow, the repayment of your capital element of a lease, the amount of lease that you are paying, the capital amount will come under financing activity. Interest that you are paying will also come under financing cash flow. And the lease payment relating to short and the low cost are classified as operating cash flow. They will come under operating cash flow. So this categories in the statement of financial position, profit and loss, and statement of cash flow. You have to know. Now comes the disclosure. Extensive disclosure requirements allow users of financial statements to assess how leases can affect financial performance, position, and cash flow. So disclosures include depreciation of your non-current assets, depreciation on your right of use asset, interest expense on lease liability, expense relating to short-term lease and lease of low-cost assets, any gain or loss on sale and leaseback contracts. Disclosures can include qualitative information such as what is the nature of leasing activity, whether there are any restrictions or covenants included in the leasing contracts. If there is, you can disclose. Now, this is part B of your syllabus, leasing. So here we have accounted the right of use assets and lease liability for lessee. We have explained the exemption from recognition criteria, that means the simplified accounting, and accounted for sale and lease back. Now, we have started the lecture by saying a contract. You first have to identify whether a contract contains a lease in it or not. Okay, how do you know if there is a lease? Two things you have to see. The right to control the use of an asset, and it should be an identified asset. Next, the lease term should include two things. One, the extension period, if it is certain that you are going to extend it, and also the termination payment if it's certain that you are going to terminate it earlier. Lessees should recognize all the leases in the statement of financial position unless recognition exemption applies. That means you will recognize the lease as expense. The recognition exemption applies to the leases of 12 months or less or leases for low value assets. You have to make the election, by the way. Where it is an applied lease payment, they are recognized as operating expense in the profit or loss on a straight line basis. That means this recognition exemption, wherever it is applied, your lease payment will be taken as expense, operating expense. And if your recognition exemption is not applied, then in the normal way, you will keep on recognizing lease liability and right of use asset. Your lease liability. Okay, so the initial lease liability will be recognized as the present value of future lease payment discounted by using the interest rate given in the question. And any amounts that are already paid will not be included in that lease liability. Subsequent measurement for liability will be you increase your liability with the interest and decrease by the lease payment. Remember that table we have done where we deduct the payment and increase the interest? Yes, that is the subsequent measurement. Then initial recognition of measurement of right of use asset is measured at initial lease liability plus any payment made before the lease have started plus any direct cost plus any future decommissioning cost. The right of use asset can be measured using cost model or evaluation model. This is subsequent measurement for right of use asset. And you can depreciate it over shorter of lease term or useful life if you are not going to own the asset at the end of the useful life lease term. But if you are going to own the asset at the end of the lease term, you will depreciate it over the useful life. If your right of use asset is an investment property, you will measure it using fair value model. in a sale and a leaseback transaction, if the transfer is sale, you will account it according to IFRS 15. You will de-recognize the asset and part of the carrying amount that is recognized as a right of use asset. A gain is recognized for the transferred part. We have done that, right? Where we have got the proportion of the carrying amount. If the transfer is not a sale, you will recognize a financial liability equal to the proceeds that you have received. There is one technical article that you have to read on your ACCA website, that is IFRS 16. And thank you for watching, and I shall see you in the next lecture. Again, the next lecture is a very the standard which is very frequently asked in your exam, that is IS 37, provision, contingent asset and contingent liability. Even leases is also a frequently tested standard, so make sure that you go through questions on leases from your revision kit. Thank you for watching.